Well, here's an interaction with Praveen Kutty, the MD and CEO at DCB Bank. Harsh caught up with them on the sidelines of the JM Financial India Conference Exchange 2025 and spoke with him at length about the bank's growth roadmap. Here's an excerpt of that conversation.
There are 2-3 parameters that we are very closely watching. The growth, having a YOY growth of 18% to 20% is critical for us. And from a profitability ratio perspective, there is a play on NIM, which is very clearly there. Close to 76% of our deposits are term deposits, and these are longer term deposits. We've made the adjustments in cost of funds, cost of deposits in the last quarter. The benefits of which you've seen partly in one quarter, and my presumption is that you would see more of it coming in over the next 3 to 4 quarters going forward. So there is a NIM play which is clearly there, because we've taken the yield hit already of a repo cut, and unless there are no further repo rate cuts happening, you would see an uptick on NIM. That's one part of it. On the fee line, what we're doing is the fee to average assets probably will remain the current levels, but the composition will change. We have had the benefit of good treasury income in quarter one. In quarter two, we'd never had that. There's been a significant drop, but that got replaced with a lot of recurring fee income coming in, and we are reasonably confident that it'll continue in the future as well. So there's a lot of work happening in the composition of the fees, but it'll be close to 1% of the average assets, and we don't see an upside coming in there, but the quality would be better there. If you look at cost to average assets, Harsh, over the last 5 quarters, steadily, every quarter, the subsequent quarter has been lower cost to average assets as compared to the previous one. We moved from the highs of 275 in Q1 of last year to the current level of 2.43. I'm very comfortable with the less than 2.5% number there. So there, the game is about keeping it steady, keeping it within the 245, 250 range. And on credit cost, we've traditionally been low credit cost company. 45 bips to 55 bips is what the model says. I would stick my neck out and say that I see the credit cost not rising. I mean, it'll be in the low 40s, between the high 30s and the low 40s going forward. So the big play is NIM, keep cost steady, change the nature of the fees, and keep the NPA to the 40 bips level, which we've been consistently maintaining.
Excellent. Now let's unpack this, Mr. Kutty. The first part of that is your NIMs. The lift you will get will be, of course, partly due to the CASA. The nature of your liability is more CASA, or rather less CASA, more TD. What does this do in terms of your margin trajectory over the next 3 quarters? As your TD deposits reprice, how much of a lift will you get in any case on the margin? Let me try and first talk about that piece. So how much will the steady state margin be just from the fact that you'll get a lift, assuming no repo rate cut?
See, one way to look at this is look at the peak rate the bank was offering 2 years back and compare it with the peak rate it's offering today. You would see that there is close to 60 to 70 bips differential very clearly there, right? Between today's peak retail TD rate and what we were offering 2 years back, you could see the difference. And we see when those particular deposits reprice over the next quarter, the next 3-4 quarters, if you keep the renewal ratio same, and which I think we are reasonably confident we will, you will see straight away a 60 to 70 bips benefit coming there. But it's important for me to tell you that we also have a hybrid EBLR book, which is fixed for a certain period and becomes floating afterwards. So every month we have some portion of our asset book, which is 2-year fixed or 3-year fixed, coming up for floating, and then we pass on the repo rate benefit. But net, I see a positive margin coming through between the benefit on the TD versus the incremental hit that you take on that portion of our loans which are EBLR linked and are hybrid in nature.
With regard to your loan mix, if that were to change, what happens to your yield? Give us a sense of that, because that will also cause a lift in margins, is my assumption. And I'm coupling that question with fees, trying to get a sense of what is causing the granularity in fees. Is it more of unsecured you're doing, which is causing the fee income to come up and be granular? Give us a take on that.
96% of our book is secured by hard collateral which you can see, touch, feel. Okay, not debtors, not book debts. So it's a very high proportion of secured book is what we have in our portfolio. That's number one. Number two is much before the NIM pressure came on board, we made a decision to change our mix in mortgages. For DCB Bank, mortgages is about 54% of the total book. It was split 27% home loans and 27% business loan, roughly 50-50. We changed the mix to 60-40 in favor of business loan over home loan. And we're seeing the benefit of that. The yield increases significantly higher on the business loan with similar credit losses and NPAs on the book. So you're getting a benefit on the yield even before the NIM compression happened. So these are the two tweaks that happened. The third part, when you link the fee to the loans, surprising as it may seem, most of our fee income is coming from our deposit liability book. Third-party distribution is a very important fee for us. A lot of transaction service-related fees are coming from the liability side of the book. Of course, there's a processing fee which we get on the loans, but the loan composition, the contribution of loans to fees is considerably less than the contribution of deposits and treasury.
Okay. And therefore, the lift on yields unlikely to happen. Is that the right way to think of it? And your mix will largely remain the same? Or do you do more of gold? Do you do more of other lending outside of mortgages, which gives your yields a lift?
What we're doing is something contrary to what you're saying.
Okay.
We would like to keep the yield constant.
Okay.
And lower the cost of deposit and get better quality assets on board. So the margin will come from lowering the cost of deposit and not necessarily from increasing the yield. We do not want to get into higher risk segment. We would like to keep doing what we are doing, and if possible by driving down cost of deposit, get into a better quality asset base which will have impact on the bounce, delinquencies, and on gross NPA. Losses probably would remain the same.
Okay, that's the conversation coming in with the DCB Bank management. Just want to